Making Roth IRA contributions, even when you make more than the government's income threshold, is oddly not that difficult. But there are a few things you need to watch out for as you try to make backdoor Roth IRA contributions. Let's make sure you're not triggering any unexpected taxes. Let's do it. Welcome back to the cleverest 18,000 financial minds on YouTube. For those of you who don't know me, my name is Steven Spicer, and it's my goal to help you not get killed in taxes and to overcome the significant risks to which mainstream advice leaves you exposed. Now, in this video in particular, we're diving into everything you need to know about the so-called backdoor Roth IRA contribution. Here's the essence of why this even exists. When your income is deemed too high by the government, you are no longer allowed to contribute to your Roth IRA the easy way. Directly. One could say through the front door. Here are the income limits for Roth contributions in 2024. For a couple, married, filing jointly, if you're making more than $240,000 per year, the bouncer at the front door of Club Roth is going to send you away. But you're responsible. You understand the extreme value that even a small contribution to a Roth account can make on your long-term financial future. So, of course, you still want to make contributions to your individual tax-free account, your Roth IRA. Now, if you don't understand why that can be so valuable for your long term, you should check out this deep dive comparison between traditional and Roth IRAs. With that knowledge, you'll be here wanting to know how you can still make your Roth contributions each year. So since we can't use the front door, we need to find a way around to the back door. It's wide open. It just takes a bit longer for you to get there. It requires 2 steps instead of 1. Now, although Roth IRAs have income limits for contributions, traditional IRAs do not, except that you have to have earned income. That's it. They may have limits when it comes to deductibility, but not for contributions. And since 2010, there is no limit on Roth conversions from the traditional IRA to the Roth style account, which means although there is an income limit when it comes to putting money into a Roth, there is no income limit on contributing to a traditional, and there is not an income limit on converting that to a Roth, which means you totally can get money into a Roth IRA even if you have a really high income. You just have to do it in a more inconvenient way, a 2-step process instead of a single step, effectively taking you around to the back door. Now, tax forms change from year to year, but let's look at this 2023 tax return so you can get an idea of how these conversions will show up for you. How your conversion shows up exactly here is going to depend on whether or not your traditional IRA contribution was deductible or not. In the end, it doesn't really matter whether it was deductible or not. Let's say you make a $7,000 backdoor Roth contribution. If the step 1 traditional contribution was deductible, for example, your return is going to show a $7,000 taxable income event on line 4B here, next to the $7,000 IRA distribution on 4A, followed by a $7,000 deduction for your initial contribution, noted there on line 10. The math is not that hard here. $7,000 of income minus $7,000 of deductions means that there will be a net impact of 0. On the other hand, if you utilize the backdoor in a non-deductible manner, which you would have to do if your income is too high and you are an active participant in your employer's plan, then your IRA contribution would produce no deduction, so $0 impact on line 10 here, and your conversion amount is not taxable since it was all after-tax money, so $0 on line 4B here. 0 minus 0, well done, we're left in the same net impact of 0. So no matter which way you go about it here, the net tax impact is 0, which is effectively recreating exactly what it's like when you just make a direct Roth contribution. Now, one place where I've seen a lot of people get into trouble from a tax perspective when trying to do this is not filing a Form 8606. When you make non-deductible IRA contributions, you need to file this form with your taxes for each spouse. If you don't, you can end up getting penalized by the IRS, and nobody wants that. I certainly don't want that for any of my clients, and that's why this is one of the many things that my team and I check every year to help make sure it's all reported and filed properly. Now, here's the one big thing you do need to watch out for before deciding you're going to pursue a backdoor Roth strategy. I'm talking about what is known as the IRA Aggregation Rule. This rule says that when you have multiple IRAs and you're trying to figure out how much is deductible or not deductible, you have to aggregate all of your IRAs together for tax purposes. Here's an example of what this looks like. If you had an existing $300,000 IRA rolled over from some previous employer's 401k, and you decide that you want to do this backdoor Roth thing. So what do? You make a brand new IRA. You make your, say, $7,000 contribution. It's not deductible because you are also participating in your current employer's 401k and you're above the income limit. So you put this $7K into your brand new non-deductible IRA, and then you convert those funds into your Roth. You say, great, I did an after-tax contribution and flawlessly executed an after-tax Roth conversion. The IRS should be happy. We should be all good. Except the IRS comes in and says, no, that's not how this works. From the IRS's perspective, you didn't convert $7,000 out of a $7,000 account. You converted $7,000 out of your $307,000 of total funds across all of your traditional individual retirement accounts, which means, in essence, you converted about 2.3% of all your IRAs, not 100% like you thought. And now, because of that, you only get 2.3% of your basis in that Roth conversion, and the other 97% is taxable. And so, at the end of the year, even though you put $7,000 into a traditional IRA as a non-deductible contribution and literally converted that account, the IRS will come in and say, no, you now have an extra $6,840 of taxable income that you now have to pay income taxes on because of this transaction. Does that make sense? The IRS is saying that of your $300,000 in your rollover IRA, now $6,840 of it is after-tax money, while the rest is pre-tax. It used to all be pre-tax, but now some of it is after-tax. But it effectively is saying that you took $6,840 of your pre-tax money out of that pre-tax account to fund this Roth. So that's why they're making you pay taxes on it. That's the IRA aggregation rule. So you have to be really careful around navigating through this. In essence, even though you put all the $7,000 of non-deductible into one account, the IRS magically merges it with all of your other traditional IRA accounts, including this old rollover, even if you've never even thought about touching those funds before your retirement. From the IRS's perspective, you don't have multiple IRAs. You have one giant individual retirement account, one giant traditional IRA that you happen to segment for personal reasons, but they are aggregated for tax purposes. That's what the IRA aggregation rule says, at least. Now, here's one big thing to keep in mind with this as you're planning for your future. All is not lost just because you have some old rollover IRAs. One thing that is notable about this aggregation rule is that it only applies at the end of the year. Even if you did the actual Roth conversion earlier in the year, you do this calculation at the end of the year. That's all that matters. Which means, if you have the opportunity, you can roll the money from your old rollover, in this example, out of an IRA and into an employer retirement plan if you wanted. I'm not necessarily advising that, but it is an option. Because the IRA aggregation rule only applies to your IRAs. It doesn't apply to your spouse's IRA, it doesn't apply to an inherited IRA, it doesn't apply to Roths, and it doesn't apply to any employer retirement plan. So you could, for example, take this $300,000 rollover IRA and put it into your 401k. Better yet, here's one that I might be more inclined to recommend to someone. If you're a small business owner, you could create an individual 401k plan, roll the money from your IRA into your new individual 401k plan. So now, the only thing that's left in an IRA is the after-tax money you converted. At that point, it would be a clean, straightforward conversion because the IRS rule does not aggregate 401k plans. So remember, as long as you do this before the end of the year, you can get out any IRAs that you don't want to be lumped into this calculation with your conversion monies. But of course, this means that the flip side also applies. As in, if in the beginning of the year you successfully execute a backdoor Roth conversion, for example, and at that time have no other IRAs, but if later in that same year you decide to roll money out of your 401k and into an IRA, now you can actually retroactively change the tax treatment of that backdoor contribution you made months ago. You can make it partially taxable because, again, the aggregation calculation does not happen until the end of the year, December 31st. That is all the IRS will look at come tax time. The bottom line with this rule is that you need to be very careful when it comes to the timing of rolling money into and out of IRAs, because the IRS does aggregate all IRAs, and only at the end of the year. So you, or your trusted wealth advisor, if your situation is complicated enough, can strategically utilize other account types as a workaround to optimize your long-term financial plan. Now, one of the biggest limitations to backdoor Roth contributions is simply that you can only do it within the IRA contribution limits. That's all the money you can get in there each year. But there is a way for some people to do way more through their 401k plans. If the stars align, the mega backdoor Roth IRA strategy, I don't come up with these names, could allow you to sock away around $50,000 extra each year in tax-free money. We'll dive into that one soon. I sincerely hope this has helped you on your financial journey. I wish you all the best. Take care.